like here, they are trying to tell you to explain. They are trying to tell you to discuss, briefly talk about the concept of efficient market hypothesis and its significance. So here you're looking at the benefits of the efficient market hypothesis to an entity like NML. So you see this question, it is actually like when you just for October 2021, you need to look at the forms. The forms, we are also going to talk about the forms. And also you go ahead and discuss the implications of the market efficiency to investors and to the company. So here you have to give two sides, the implications of this. Is it good to the side of investors? If it is good, to talk about the merits and all the merits, depending on how you're trying to explain your points. Okay, it's all about trying to explain your points, but we are going to also discuss here. You're looking at investors and the company. Okay, same applies to this one. So you see, model paper, I think it was more of this. Just for model paper, they looked at implications of the efficient market hypothesis to investors and the companies or managers. So here, October 2021, you're looking at the forms and the implications. But what is all about the market efficiency? What is all about this market efficiency hypothesis that we are talking about here? So you're going to okay, so here, okay, so when you are looking at the efficient market hypothesis, it states that the security prices fully reflect all available information, making it difficult for investors to consistently earn abnormal profits because they have the information. Now, the way I put it here doesn't mean that you cram the way it is. No, you explain the way you understand it. Eh? So here we are just trying to say that when it is market efficiency, it means that what we see, the prices you quote for the security that you're selling, or for the security you're saying, and I want to buy, I believe that the price reflects the information that I'm aware of. Okay, so that is the assumption that the prices that are stated in the market reflect all the available information. Remember, if you are an investor, you always try to do research before investing in a company. Sometimes you find that you always try to first do some research about the company. Maybe looking at their records, the financial statements of the previous year, how they have been performing, okay, and any other information, okay? So we assume that if we are talking about efficient market, then it is the market where the prices quoted in such a market reflect the information available to us as investors or to the public. Okay, so it will be hard. It will be hard for an investor who always rely on information to beat the market. Okay. Sometimes you find that there are those investors who have information about the company, maybe because of the insider information. So here we are saying that whether it is an insider information, whether it is those records published, all investors have such information. So you as an investor, you are not going to earn the profits because of such an information that you have as an investor. No, if it is an information, it is available to all. So basically, that is the efficiency market that we are talking about here, the assumption that we are making. Of course, in reality, these things are not true. You understand that? Yes, sometimes somewhere, the prices may reflect based on the information. Maybe, for example, the company has published the financial statements and they are in profit position. They are saying that they are going to pay dividends worth this. Okay, that information, all investors will immediately have that, and it means that the price is going as well to increase because of that information. So it means that when you're planning to invest in such a company, whether me as an investor or the other investor, all of us will have an equal information. We will have everything about what? That is basically about this efficient market hypothesis. I don't know whether it is a bit clear. And now that I have tried to explain core, you can unmute and add something before we look at the forms. Before we look at the forms of the efficient market hypothesis. So far, any addition? It is a discussion. Remember, it is a discussion. Okay, I am not going like the way question is, explaining the concept, then immediately you go to significance. I'm handling everything at once. So far, at least, do you have a hint about efficient market hypothesis? Is it okay?
The way I understand it in summary, Able, is that it is the extent to which the prices on the market portray, like the pricing at the market portrays the past, present, and the speculative information or future information. That is always an assumption. But
Exactly.
it may not be possible, as you have intimated, it may not be possible that the prices reflect all the information. And I think that's one of the weaknesses. Yes, thank you.
All right, that is great. Another person? Are we all on the same page? Please, if it is not clear, I know some of you because we are taught by different tutors. You may find that for you have not yet covered this area. Don't be scared. That's why there is such a discussion. So just when something is not clear, you try to ask. You try to ask me, or the other person can help you and maybe understand better. So that is about the efficient market hypothesis. Okay. Now forms are forms. So we have three forms. We have three forms of the efficient market hypothesis. We have weak efficiency. Then we have the semi-strong, and then lastly we have the strong form. Strong form. Should I increase the font? Are you in a position to see very well? So we have three forms. So the first one is weak, then second is semi-strong efficiency, and the last one is strong efficiency. Now, what is all about weak form efficiency? What is it all about? Here we are looking at the past. This states that, or this looks at this. Let me just try to summarize. This form asserts that all past market information, are free reflected in the current prices, in the current share. It can be like the current share price, depending on the security you are talking about. Okay, so that is weak form. You are looking at the past data, the past information. Okay, so we are saying that if it is weak, you are looking at the past information. The past information could be what? It could be that the historical prices. The historical prices, how in the previous periods, what was the price of such a security? Is it reflecting when we look at the pattern? Okay, so you look at such a data, and then you also look at, for example, the trading volumes, the sales volume, and any other trend. So as long as you're relying on the past data, if you're relying on the past data to come up with the price, then that kind of the price that will be reflected will be in the form of what we call the weak form efficiency. So here you are looking at basically the past market information. So if you are an investor who first analyze the previous prices for a security to beat the market, then still you will not win, because we are saying that the past information reflects the previous information. The past market information reflect the what? Reflected in the current prices that you see. So there will be no need of you going back to analyze such an information. All of us as investors, we are comfortable that the prices we see currently reflect the past information, and that form is weak form efficiency. So investors, you cannot use the past price patterns, the technical analysis you cannot use the technical analysis here to predict the future price movements. That let me analyze the previous data and I predict what will be the future price. That one will not work, because all the information will be reflected. Okay, so here we say that the prices follow a random and unpredictable pattern. Okay, so for weak form efficiency, the technical analysis is ineffective. Those who rely on analyzing the previous data will not work here. Okay, so that is all about what? That is all about weak form efficiency. So the technical analysis here, is ineffective. You cannot apply those analyses to beat the market. Okay, so that is weak. Then semi-strong. Semi-strong here you are looking at all the publicly available information. Or okay, this form, we can say that this form states that that all available information is already reflected in share price. So we have investors, or we have category of people who look at what the company publish. They first look at what the company publish in terms of, it could be like, here we are looking at the public information. The public information that you are talking about here are like you see here in the first case, we are not looking at what? We are not looking at those documents that you publish. We are just looking at what? The past market information, how the prices have been, in terms of sales and any other trend. But here with semi-strong, we are looking at what you publish as a company. So it could be the financial what? The financial statements. People who analyze those to look at the financials before investing. So we are saying that the public information here, we are looking at things like the financial statements, which the financial statements could be the annual reports, any report that you publish. It could be about news announcements. You make announcement that you're going, maybe as a company, you maybe you're going to invest in a certain, you're going to declare dividends, such announcements. So once such information is released, okay, the market here, we are saying that the market adjusts quickly, and actually in a way that investors will not earn because of such a what? Because of such an information. The market that reflects, the price that reflects in the market will be as a result of such an information that is available to the public. So here it means that you who normally do what we call the fundamental analysis here, trying to analyze such kinds of documents published, this one will not help you, because already we are saying that the price reflects the price of that security. It could be like a share, okay, already incorporates that kind of information. So this fundamental analysis becomes what? Becomes ineffective. So the first one here, we looked at the technical, where you're looking at just the past market information. Here, you don't need to do those analysis of, I look at the financial statement, I look at the reports, I look at the information, any other information published or announced by the company. So all these will be what? All these will be reflected in the price. So that is semi-strong. So here, of course, before we talk about when I say semi-strong, it means that technically, it means that also this one, the past market information reflects. You have the past market information and also any other published information. So you don't need to say that now semi-stronger doesn't include the past market information. No, it includes just this one. This one adds other information, like what the company publish. Are we together? So here you look at the past information, the past market information, plus those plus the information published by the entity. Okay. Okay, so lastly we are looking at what? That is strong. Now, stronger is very, very key in a way that we are looking at all information, both public and private. Okay, so this form asserts that all information, both public and remember, just looking at the information, you will have access to such information. But you find that sometimes there is information that is not published. Okay, so when it comes strong, we are looking at what is published to all users, whoever is interested in that information. So stronger, we are looking at information that is both public and private. Okay, so that information will be reflected in what? Will be reflected in the price, in the price. You are looking at what? Information. So strong efficiency, both public information and private information, is reflected in the what? In the security price. So here the no investor can what? No investor, including the insiders, those managers. Sometimes you find that it is a coordinated deal. Find that it is a coordinated deal. People in procurement are coordinating with suppliers. So those who are going to do the evaluation has already given information to some of. So such kinds of what? Such kinds of arrangement. So here with stronger efficiency, but obviously in practice this doesn't normally happen. This is not true. Inside the information is always not reflected sometimes. So, but here the assumption is that we assume all the information, both the insider information and what is published, or what is available to the public, reflects the market, so reflects the price you're quoting. Okay, so that's all. That's all here. So basically here we are saying that you as an investor, you cannot outperform the market because of such an insider information that you have. It means that even others know, which is not always the case. It is hard for all of us as investors to know the information that is not published, that is not available to the public. Sometimes it is hard. You normally hear the word Gambano. Do you have someone there inside? So sometimes it is hard, but that is the assumption. We assume that if it is stronger efficiency, whether it is insider information, it is known to all investors. And that information is reflected in the price you're quoting for that security. So you normally see prices keeps on changing. Those who normally follow you, sometimes you see the price keeps on changing. You wonder how can the price change? It is because of information. Sometimes you be there, information has leaked. And once the public knows, the price is going to change. Because of that, such kind of In a scenario where they ask us to explain forms of efficient market hypothesis, I believe we'll try to write something. You can use your own words. All those who have handouts, books, textbooks, you can try to go through and see. Just here, I tried to summarize. I tried to summarize, but I believe some of you have the text, the study packs and all the textbooks from different tutors. So far, any question? I'm done with forms. So we are done with this part where we are discussing the forms of market efficiency. We are done with that part. Okay. Do you have any addition, any subtraction? Remember, I am also going to do a paper. So it doesn't mean that I'm perfect. I also want to learn from you. I may be knowing these things in a wrong way. So you help me as well to understand. You get
Yeah.
so you help me and I understand. Sometimes I may put something here and you see it is wrong. Don't keep quiet. And as I do this, I am mastering and I'm also learning from you. So any addition? Any addition?
None from my end.
Addition? There is August 2024, sorry, 2023. That is the first question that had 9 marks. First note that, and this was the question. Then we have also this October 2021, question 5B. It was taking 14, I think it was 14 marks here, yes. 14 marks here. Then the model paper, the model 2023 question what? Question 2B, where they were asking us to discuss the implications of the efficient market hypothesis to investors, then companies or managers. Also, this was 6 marks. So that's what we are trying to discuss. I believe it is okay. All right, so let's see. Let's also what could be the implications of the market efficiency? Here we can, before I give my points, you can try to. Okay, let's start with the implication of market efficiency to, let's say, a company. To a company. What could be the issue here? Okay, because the price you're quoting reflects the information here. So what does this one mean? Since the investors are aware about the entity, about everything, they are aware about your performance, how the prices have been. So as a company, what should you do? Since you're aware that the investor, so sometimes when information is not available to the public, you can end up cheating the investors. Maybe you overstate the price because these investors are not aware. Okay? But the fact that now the investors are aware, it means that as a company, you have to cook in another way. You have to look at another way. So it means that here, you should focus more on wealth maximization. Number one is that to the side of the company, Their focus now should be on how they can maximize the wealth of the shareholders. Okay, other ways they can maximize the wealth of the shareholders. So here we can let me just use A here. Then we can look at one, you as the entity. Focus on what? Focus on wealth maximization. Wealth maximization. What do I mean here? We are saying that the prices, the security price, since the share price, for example, the security we are talking about, let's say it is a share. Since the share price reflects all the available information, then you as the manager of the company, try to make sure that you focus on making value-adding investment decisions rather than attempting to do what? To manipulate share prices. You know that one of the ways managers may do to maximize the wealth is just focusing on manipulating these prices, and they end up not looking at other side. So it means that you need, as a manager, you focus on what? Focus on making value adding investment decisions. So you don't need to focus on just manipulating the sales price to increase the profit. No. So that should be number one. So if we are looking at the company, we are looking at the company as a whole. But this point can work in a scenario where they are saying you also discuss the implication of market efficiency to managers. So you as a manager, finance manager, you as a manager in any capacity, focus on other things, not just on the prices. Okay, on adjusting the prices, because you know the clients or the investors are not aware. So that is number one. So make good decisions, because once you make good decisions will automatically be reflected in the higher share prices. You are making viable, you are trying to say, let's look at ways we can add value. Maybe we try to spot we look at some projects that can add value. We invest money somewhere. Once we invest and we perform well, that performance can help us to increase. We justify the increase in the price, not just manipulating without justification. That performance alone, once the public is aware that the company is performing well, they will be interested to invest in your company. That's what we are trying to mean. Okay, so that is number one. So remember, implications can be positive and negative. So don't focus on only the good part. You also bring other points. It could be also the increased investor confidence. Because what you're stating as a company, since it reflects the information that is available to them, then they can do what? They can really trust you, and it will be easier for them to do what? To go ahead and invest, and it will help you as a company once investors trust in you, then they are going to bring capital. This will help you to raise capital, because investors are going to do what? are going to inject in your company. So here, this will help the company to raise what? To raise more. This will help the company to raise more capital in the long run. Okay, so guys, you add more points. You add. Let's make like 6. Don't just copy what I'm saying. Yeah? Let's add. Let's add it together. What else can I add? From just what we have discussed about market efficiency, information is available to the public. So how can that affect the company? Positive side and negative side. That's what we are trying to discuss.
Allow me to try.
Okay.
That may be related to the previous answer, that company valuation becomes easy when there is already information in the market. Like when you make an evaluation and you put it out there, it is easy for someone to believe it because there is a basis of trusting the figures in the valuation. Yeah.
Okay. So is it another point or it can come here? Company valuation. Who benefits on this? I think who benefits on this? The investor, the company.
The investor.
The trust. Maybe if it is, we are building on the trust from the investors. Help me understand your point. Is it to the side of the company? Because we are looking at the implication of this to the company, and we are going to look at the implication of this to investors. So company valuation, is it a benefit?
Was to the side of the investor, but also to the company. I know with company valuation, sometimes you can value, you give out your figures and then they are objected and then you have to go back and forth in adjusting and making things. But now, if the information is already out, it also saves you time. Like someone is able to believe your numbers fast without you having to go back and put in more time. You can help me rephrase it.
All right. Then next. You got gentlemen in the house. By the way, don't think that what we are discussing is a lie. You know, today is 1st April. Being 1st April, you know, you may think that we are doing.
I think also to the company, it makes it when someone, for example, wants to acquire a loan or funding during the application and assessment. I feel like the information, like the public already knows either you're performing or you're not performing, and then they're able to assist you easily or acquire the loan funding.
Then next, the negative side. Negative side, we are looking at things like inability to do what? Inability to time the market. In a way that you as a company, You cannot issue, there is nothing like issuing a security at the perfect time. Some people normally first wait, and when they see things are okay, they do what? They issue a shareware bond, which may not even add any value in this case. Those things of first saying, let me first wait, at a particular date. Remember, we are saying that here, the future price already even is reflected in the what? In the price you're going to state, or you're going to quote. So it means that here, it will be hard for you to time, when can you what? When can you issue this? It can indirectly affect you. So since public information is already included in the price, there is no way you're going to say, okay, let me plan and I issue my shares, I issue my bond this particular period. So no timing advantage here. No timing what? No timing advantage. You know, in accounting and tax, timing is very, very key. Timing of a transaction sometimes is very, very beneficial to a person. So, but in this case, we are saying that because of market efficiency, you may not benefit on that. Financing decisions that you're making should be based on need, not just timing speculation. Okay? Make those decisions not based on time, based on the need. Okay? Okay? Then next, no abnormal what? Because we said that also sometimes it is no abnormal profits from insider information. Something that we have to also include because of that stronger efficiency. So we discussed that under strong efficiency, both public information and private information is reflected in the share prices. So you as a company, there is no way you're going to benefit because of that insider information. But technically, you see, this is normally this third one doesn't work. Insider information, it's a bit tricky. It's a bit tricky. So in reality, we are saying that insiders, like managers or any other person who is working with that entity, may have an information and maybe say that let me invest in this company because of this A and B. Let me coordinate with my team outside and we make the bid, we try to bid and because of what they are seeing. So it is something that you have to look at as well. You're not going to benefit on that. Someone in the chat. Can I also say loss of confidentiality? Well, of course, the theory questions, you just put a point and defend it. You will hear that during our webinars. Let me hope you have registered. By the way, we need to register. So, loss of confidentiality, well, that one can be there, but you explain the confidentiality bit of it. Loss of confidentiality. Okay. Because we are saying that even the inside information is available. Sometimes you need to hold that as and keep it as confidential. You as a company, you don't want everything to be disclosed. So that competition. That's where I even hear people bring in issues of what? The competition bit of it. Once information is available, I can as well structure my transaction to beat you. So you can also as well look at it from that angle. Once information is available to everyone, I can what? I can rely on that information as a competitor to strategize and be accordingly. Or we compete accordingly. Then next. You're going to search more? We just move to the next.
I think it also informs decision making, especially on the side of investors.
That is the point.
I don't know if it fits here though.
Investors. Remember, they are still on the company. What could be the implication of this to the company? To the company, we can add more.
Does it also help maybe the company to sell more stock?
Sell more? Yeah, it can be there. Because once they see that, once maybe these investors see that you're doing well, they are going to, the demand will increase. The demand will increase. And
Isn't that point? Isn't it fitting in point number 2?
Point number 2 there. Point number 2. Increased investor confidence. Once this is increased, these guys are going to invest more. And you see, I think it is more of the same. More of the same. So these guys are going to buy more. When they buy more, you're saying so here, I think we can stop on this. We do more research. Maybe also you have a quick review around what the examiner included from the guide. From the guide, you will check what the examiner included, and you read from there. Then to the side of investor, what can we write? What can we put to the side of investor? To the side of investor, still you have inability to do what you as an investor, inability to consistently do what? To consistently earn abnormal returns. Investors, you as investors, you cannot consistently do what? Earn returns above the market average. Because we are saying that information that could help you or that could be used to gain an advantage, the information that you could use to gain the advantage is already reflected in the price. And when new information arises, many investors as well are going to act. Once information is available, other investors are also going to do what? To act. So it means that you as an investor who relies on just information to gain your returns, here it will not work for you. It will not work for you. Then we also look at the issues of, we talked about things related to technical analysis, things related to fundamental analysis. You can as well put it here, like it is limited to what? Limited usefulness of the technical analysis. You are to the side of the investor. Still, you also put the point of fundamental analysis. You don't need to do all those things. So here you can just say limited usefulness of the fundamental analysis. You recall what I said? And technical analysis, what did I say? Remember technical analysis, you're looking at the previous what? The past previous movements. Here we are saying that because past previous movements and trends are already incorporated into those current prices, you are not going to do those analyses. You're not going to look at the trends, how the performance in 2023, you compare it with 2024, you compare it with 2025, and you make a decision. That one would not work here. That's what we are trying to mean is technical. You're looking at those patterns, the trends. So that one will not be needed here. So by the time an investor acts on the information, the market has already adjusted. So you don't need to do those what? Those kinds of what? Those kinds of analysis. Still, same applies to fundamental. Remember fundamental analysis. This was related to you looking at the public available information. You trying to analyze information like financial statements, economic reports, all those ones, the information that is published. Because of that information, that announcement that the entity has made, it means that also the market price is going to react, is going to be adjusted, okay, because of that information that is available to the public. So you don't need, you as an investor, to go ahead and do such analysis. Okay, that's what we are trying to know here. So still, to the side of investor, you need to look at the importance of investing, passive investment strategies. You don't need to just focus on there are people who just focus on looking at the prices of the security and they just do what? They just invest. No, it means that you as an investor, you need to know the importance of what? You need to know the importance of passive. It will force you, this market efficiency will force you to come up with different strategies. So you are, because of this market efficiency, you are encouraged as investors to adapt passive investment strategies. Okay? Diversify. You may prefer, you as an investor, you may try to, because you know that, okay, since everyone has information about this entity and all this, you can decide now to diversify your, and you have different portfolios. Maybe you invest here, it will help you. It will help you. Instead of just focusing on one entity. So here you're looking at, you emphasize the point is on diversification. Try to do what? Diversify. You will manage the risks. You manage the risks around, and you can earn if the performance of the company A is not well, you can earn from the other one. Okay. All right. What else? So no advantage still from what you can, if it is a separate point like here, you as an investor, you're not going to earn, but it can come from this point. No advantage from what? No advantage. No advantage from insider information. Sometimes you rely on that to earn the abnormal profits. Okay, what else can we add, guys? Do you add more points? Still, you as an investor, you're not going to wait for the time, right? All these points can still come here in a bit time in the market as an investor. Eh? You cannot predict the best time to buy or sell your security here. To buy or sell your securities, because here prices already reflect all available information. So still this point can come here, this one. Because there are investors who try to time when can we invest. You guys, you add, time is taking me, I have to try to add. Are you adding or you're asking? Are you adding? Any question so far? Any question? Let me hope once we meet such kind of questions, we are going to clear. When they ask you significance, of the market efficiency, we have discussed them. Okay. Here you will have questions around this is, you check September 2022 2B, then you check December 2022, then June 2022. Then there is like a part of March 2022. I think it was a bit common around this. Okay. This is a graphical representation. You see the graphical representation showing the relationship, showing the relationship between, in this case, we are looking at the interest rate between the yield of the what? The yield of the security, and these are debt securities, the yield of debt securities, and what? And their time to maturity, So that is the yield curve. So it is very, very, key. It's a key tool to use in finance. Those who are managers, who are not like us, who are in tax science. So it is a key analytical tool in finance because it is going to help you find that you need to look at, should I give loans, okay, you'll find that more of it is going to help you in terms of setting the rates as well. As you set those rates, you're going to think about the inflation bit of it, the economic activity. You analyze different things, the market expectation about those parameters like future interest rates. What is the market expectation around those things? What is the market expectation around the inflation, around the economic activity? So it will guide you, it will guide the financing decision and the investing decision. This yield curve that you see here. Okay, so when you get time and have a quick review around these questions. For example, let's open like December 2022, and you see December and June. So September, it is, let me just open all. Which screen are you seeing? Just you let me know. I'll be sure that I'm not alone here.
Okay, now the question.
Okay. So we have the September. You see what we were discussing? I think we had not included that. You see, it is common. And it always carry good marks. Can you answer now this? September, you add it on your list. You add it on your list because you have discussed this area. You add it on your list. I had not included it. You add it on a list. Okay. So here you have, it was question what? Have you seen the question? Around the, oh, this one doesn't. Just where did I include it? This doesn't have a yield. It's just okay. I think I included it because of that part. Let me open this. June 2022. Are you seeing June 2022?
Yes,
That
we
is
are
the paper you are seeing?
Yes.
Are you seeing these marks? Relevance of yield curve and factors that determine its shape. You have there 6 marks.
Mr. Abel.
So here, pardon?
Yeah, we are seeing the question, and I'm also on December 2022. It is actually the same, like the same.
So when you look at December 2022, let me just also have, and I see what they had asked here. December 2022. December 2022 is about what? Still question 2 part C. Are you seeing they are trying with the same, December 2022, the same question. The relevance of yield curve and what? Factors that influence. Okay, the same question. Same marks. 6 marks are many marks. March 2022, it was about this. Please you read. This is capital market lines and security market lines, still 6 marks. And these are very, very good marks. These are very, very good marks. You find that you know the calculation, but you don't know the theory. And also still the same year. Are you seeing this? Still the same year? Still 6 marks. So factors that determine the shape of yield curve, a very common area, a common question around that. Then this one I wanted also you have a quick understanding around the capital security lines, capital market lines, and security market lines. Now that you know the definition of the yield curve, we want to know what are those factors. We want to know the factors that can determine the shape of the yield curve. Okay, the factor that can determine, because this is a graphical representation. You will have an increase, a decrease, a sharp decline, a sharp increase, depending on what? Depending on these factors that we are going to read. So the factors that determine the shape of yield curve includes what? Do you have a hint? One, it is what? Someone has something.
One of them can be like the liquidity preference, in a way that if some investors prefer money today than money tomorrow, I think because of the aspect of time value of money.
That is very right. That is very right. You need to compensate. You need to compensate someone. For example, we have people who prefer to have money now rather than investing it for what? For a long period of time. So if such an investor is going to invest in a long-term security, he will be expecting a premium, a return for such a what? For such an investment. So all we know is that investors prefer short-term securities because they are more liquid and less risky. That is from the investor's perspective. Most of them, okay? So to persuade those investors toward long-term securities, it means that you, the issuer, must offer a liquidity premium to compensate such kind of investor. Okay? So what does that one mean? It means that this premium that you're going to pay as an issuer, the premium increases with maturity. The more investors are going to invest, the more premium you're going to pay. So the premium increases with maturity, and that will lead to higher yields for long-term securities. And because of that, you will have what we call an upward sloping yield curve. Okay? You will have a curve that it is what? Increasing in that way. More premiums with a high maturity period, long maturity period, and that increases the what? Also that increases the returns, the yields, and in the long run, you will have an upward sloping curve. Then point number 2, let me hope you have understood the liquidity preference. Remember, we have a curve on vertical axis. You guys, on vertical axis, you put a parameter. On horizontal axis, you also put a parameter. That is time to maturity. You have time to maturity, then you have also, depending on what you're putting on vertical axis, what do we put? For this, when you're making on vertical axis, what do you put? What do you put?
The yield to maturity.
The yield.
And then time to maturity.
On horizontal?
Time to maturity.
Okay. So we have point number 1, liquidity preference. Then number 2, some speed.
Habitat theory. In such a way that investors have the zones, the zones of investment. For example, maybe if you draw that graph, it can display it there. But they have different preferred zones of investment. In that if they cannot exceed those zones, then they will have to recoup their yields. Maybe before you can explain that, we can also talk about the fact that the longer the maturity, the higher the yield, and I think that's obvious that it will lead the yield curve to be upward sloping.
Okay, that is. I hope colleagues on call, you have captured that to the right point and well explained. If you are to convince such a people in such a categories, in such a investment horizons, then you have to compensate as well for them. So that additional return will cause variance or some shape to change. The shape will remember here we are talking about the shape, the increase, the decrease. What can cause that? Or the preferred habitat theory is very, very key. The theory extends what? The markets. Okay, before you even look at the preferred, there is always that point, that factor around the market segmentation theory as another factor that this theory argues that the bond market is divided into distinct distinct segments based on the maturity, and each segment is influenced by its own supply and demand conditions. So if it is, let's say, pension funds, you may find that primarily the pension funds demand long-term as securities, while those commercial banks may prefer short-term instruments. So these preferences affect the prices and yields independently across the maturities, depending on the on the segment you're looking at. Okay. So when you look at the market segment, the market segmentation theory, you also immediately think about the preferred habitat theory in a way that now with the preferred habitat theory, you're just looking at the time bit of it, that me, I have a time where I need my money in this kind of period. So if I am going to exceed that period, you will need to compensate. Here you are looking at time. Here you are looking at what? You are looking at money. Okay. Then you have someone in the chat talked about inflation. Yes, it must be there. Inflation, what? Inflation expectations can influence the shape. Because inflation influences the interest rate, especially for long-term securities. If investors expect higher inflation in the future, obviously they will demand higher yields to compensate for the loss of purchasing power. If you as an investor, you expect a higher what? A higher inflation. You will need also, because you're taking high risk, so you will need more compensation. So that one around results into an upward sloping yield curve. But in a scenario where we expect a decline in the inflation, then that one you may have an invert or flattened curve. We have those kinds of curves we're going to read through. But inflation, I hope you have captured that if we expect a higher inflation, then the investors are going also to command or to ask high returns. What else can we add? We can talk about, there are a lot of issues, even the interest rate alone, the expectation, there is expectation, the expectation theory, which connects the future what? This is in line with the future interest rates. So here, according to this theory, the shape of the yield curve reflects market expectation about the future what? Especially the future term interest rates. If you as an investor, you expect the interest rates to rise. If you as an investor, you expect the future interest rates to rise, then the long-term yields will be higher. The long-term yields will be higher than the short-term yields. And that can change the shape of this curve. Okay? So the expectation always think about to always look at what mostly we look at what the central bank publishes. Sometimes it guides. So you always look at the expectations about the future economic conditions can influence the interest rate, the future economic conditions, or the monetary policy. Remember, this is done by the Bank of Uganda. They are the ones that normally publish those what? They normally set those CPR. So some other institutions based on that set the rate, set the interest rate. So if, let's say, Bank of Uganda publish and they say the central bank rate, the central bank interest rate is at this, highly likely you'll find that other institutions are charging at a higher rate. So that kind of information can also end up causing problems, especially in terms of this cap. It keeps on it keeps on changing, because also institutions will keep on adjusting the price based on how the market is performing, based on what is published by central bank, among others. Then what else? What else? Are we done? What else? The supply and demand can also as well influence the supply and what? The supply and demand for the security. The interaction between the supply and demand in the market influences the yields at different maturities. That one as well can be there. For example, you realize that an increased demand for long-term rates bonds raises their prices and lowers their yields. If there is too much demand, what will happen? Just look at that. If there is too much demand for a security, what will happen? Their price will increase. If there is too much demand, what do you do? As a supplier or as a seller, what do? You increase the price. So the price is going to increase, and along the way you find that even the returns now are not going to be the yields. That lowers actually the what also the yields on this car. Someone wanted to add something, please go ahead. But my time is over. Please go ahead. Someone wanted to add something.
There is a point of macroeconomic issues, but I usually don't know how to explain it. So from here you can help me.
Microeconomic, you're looking at those things of, isn't it those things of interest rates, movements? I don't know. People studied econ. You're looking at inflation. You're looking at those from the perspective of central banks. Let me hope I'm not here. You guys, you can go ahead and explain.
You can take it to central bank policies. When for example, when the central bank wants to curb inflation, it will revise its CBR, and those short-term central bank policies, monetary policies. They can explain those macroeconomic policies. So, for example, if there is if the central bank wants to curb inflation, it is going to increase the CBR. So when it increases the CBR, it would mean people will not borrow. So the banks will have the central banks will increase their lending rates. That's limiting borrowing, and that means in one way or the other, it is going to affect the interest rates of securities. So in that line, really, you can look at it in that perspective. Maybe Abel, there is this point of the market segmentation theory. I beg your pardon on if you could shed more light on how best I can put it on paper, or how best I can understand it in the layman's language. And the preferred habitats theory, those two.
Someone who had asked about microeconomic, are you okay now?
I think I am okay. I am okay to some extent.
Some extent. You asked him to shed more light on this. Here, market segmentation theory. The market is divided into two groups, or two segments. Here, the market is divided in two segments. You find that either you have the short term, the medium term, the medium term, and the long term. For example, when you look at the bond, you find that you have different periods, short term, medium, and long term. Just look at it from that angle. Now, you are going to find that investors and even the borrowers usually stick to one segment. Some of them stick to one segment because of their needs and preferences. Okay, let's say if the bank is the one going to buy the bond, they would prefer short term. But look at a pension fund like, let's say, NSSF. If it is like NSSF that is going to buy the government bond, what will they prefer? NSSF, they may prefer long term. They may prefer the medium term. So it really depends. It really depends on the entity, some depending on their needs and the preference. Okay, so how does it affect the yield curve now? Is that since each segment has its own demand and supply, you are going to find that the interest rates are determined independently in each segment. So the interest rate for short term can't be the same as medium, can't be the same as what? Long term. Remember, interest rate, you're putting the yield on vertical axis. That yield is as a result of interest rate. So it means that since those interest rates are different, automatically the shape of the yield curve is going to also be different. Okay? So you'll find that the higher the demand for short-term bonds, the prices rise and the yields will fall. The lower demand for long-term bonds, prices fall and the yields rise. So because of those what different rates, the shape of the yield curve is going to change. I hope you have picked something. I hope you have picked. I don't know whether I have tried to break it down, but that's basically about market segmentation theory. That's basically market segmentation theory. Is it clear to someone who had asked? Is it a bit clear to someone who had asked?
Yes, please. That is.
Then for preferred habitat theory, now for preferred habitat theory, it just improves on the what? On the market segmentation. Just in simple terms, you're looking at if investors have preferred here, here it basically says that investors have preferred maturity. Okay, that is habitat. Habitat, just look at it in terms of the maturity period. For some investors prefer a certain what? A certain investment period. But they are willing to move. Okay, these investors, yes, they have a preferred investment horizon or investment, just make it an investment time horizon. They are willing to move to other maturities if given extra what? Return, if given extra premium. That yes, I may be an investor who prefer to buy a bond of, let's say, 3 years or 5 years. But if I realize that the return if I realize that there is more return if I invest in a wrong security, then I can go ahead and do what? I can go ahead and invest in such. So preferred habitat theory look at it in terms of investment time period, maturity period. That we have categories of investors who prefer a certain investment period. That for them, they would rather invest in a project or in a security for 5 years. But if there is a compensation, a higher return for me to invest in beyond 5 years, then I can do what? I can go ahead and invest. So how does that now affect the yield curve? Okay, so you are going to find that investors are asked to invest outside what? Outside their preferred range. And they will demand extra compensation. They will demand the risk premium. We normally call it that, the risk premium. Look at the market rate, the return on market minus what? The risk-free rate. So you are going to be compensated by that risk premium. So you are going to find that yes, investors prefer short-term, like short-term bonds, and they are going to invest in long-term bonds if they yield high interest. So what does that one mean? If I am an investor and I go ahead and to invest in a long-term bond, let's say, the curve is going to change. The curve is going to change. Long-term yields become higher. So you will attract more clients because they have seen that now investing in long-term, let's say bonds, they are going to earn more. So clients will be more. So long-term yields become higher than the short-term yields, like what those guys are going to earn because they have invested. The yields will be high. Okay, the yields will be high than the short-term yields. That kind of just movement changes this. And when you draw the shape, just that here I don't want to draw those shapes. But when you draw the shapes, you see technically, as long as you're a person who stick to 5 and you go beyond 5, the return is going to increase. The yield is going to increase. The more the time, the yield there is going to increase. So that's how I can explain it. I don't know whether we have people who can make it more summary, but I believe in an exam you'll have something to write at least. Isn't it? But that's how best I can explain these two. So here, basically, you are looking at the time, the preferred time. If you go beyond your preferred time, you should be compensated. It means that long-term the maturity period is going to increase and the yield is going to increase as well. That alone changes the curve. I have moved from my preferred to another period. So compensate me. High return, high maturity period. There is a movement in the curve. Market segmentation. These securities are categorized into markets. Those who prefer, because we have those who prefer short term, medium, and long term. So, because of that as well, if someone prefers short term and is going to maybe move away from that to another, you will be compensated because of that. Okay, okay. So I am done. I'm done with this. The relevance, my friends, read. You read. The read time is really not on my side. You read, you read, you read, you read, you read, you read. And I will not have time to come back for this. But relevance, you look at issues like now. Your relevance, you are looking at issues of predicting future interest rates. As point number one, it is easy to predict what? Forecasting. It is easy to forecast the interest, the future. It helps in forecasting the future interest rate. Very key. Future interest rates. For example, if investors believe that central banks will increase the policy rates due to inflationary pressures, or then the long-term yields will rise to short-term yields, depending on what is stated. This yield curve tool is a forward-looking indicator, and it enables you as investor firms, institutions, policymakers to anticipate all those things. Indicator for those things it is an indicator of economic conditions as well. The yield curve here is widely regarded as reliable leading indicator of microeconomic performance. Its shape, the shape of the yield curve, provides insights into the stage of economic cycle. So when they want to measure the performance, the microeconomic performance, someone can use what? Someone can use the yield curve. They look at the normal upward slope, the normal upward sloping curve. You look at the flat yield curve. So every curve tells you something. Tells you something. For example, like a normal upward sloping curve, it is associated with economic expansion. Because their investors demand high returns for long-term investments due to growth and inflation expectation. So, okay, so you find that like central banks, analysts, they closely monitor the yield curve to assess the economic health and predict the future trends. It also, you may talk about the profitability of, let's say, of the financial intermediaries. This yield curve plays a critical role in determining profitability of these financial institutions, particularly banks. Remember, banks typically do what? Operate by borrowing short-term funds. Some of them, you borrow short-term funds and you lend. you lend long term, like loans and mortgages. So you will find that when the yield curve is stronger, that is strong upward slope, then the difference between the short-term borrowing rates and the long-term lending rates is high. I don't know whether it makes sense. Okay? So it will help, because when you're a banker and you find that you realize that you want to make profit, obviously you always look at now what the government is. You buy the bond, so you borrow. It could be the customer's deposits through that. So you borrow and lend. But of course, because of those circumstances, you're going to find that you analyze the rates and set a lending rate higher, and it will help you to make sure that you earn more profits. So every curve tells the bank something. If you find that the curve is flat, the bank will interpret it in a different way. If they find that the curve is upward slope, the bank will interpret it in a different way. Portfolio management and strategy formulation, all those things are there, because you need to know, you as a portfolio manager, you have to use this curve structure and manage your portfolios to make sure you align your investments in a particular in a specific maturity range. We have also other strategies. Okay. Issues of monetary policy and economic management. Central bank will rely on this. Rely on this because central banks influence short-term interest rates through monetary policy tools. So these changes affect the yield, which in turn impacts the borrowing costs, investment, and even consumption. So this yield curve still influences the monetary policy. Very, very key. And economic management. Determination of the cost of the borrowing, it could be there. So friends, get time and read and search. Good thing these days, there are a lot of ways you can read these theory things. For now, I thank you for staying on, and we can meet next time. Maybe in a scenario where you have a question, you can ask before I quit. Please read. Time is going. Read. It is personal effort, not discussions. Discussion just add some percentage, but personal efforts. You reach in an exam, you know a point, but you can't explain. So also try to know how to explain these points, because theory you keep on hearing that it's all about how you explain your point.